Hello everyone, welcome back to Swadhyay. In the previous lectures we have discussed basic concepts of income tax and then we have discussed about residence and scope of total income. Today let us start the new chapter, that is heads of income. We know that to assess the tax liability of any person, first we have to determine the total income of the assessee. To determine the total income of the assessee, his possible incomes are divided into 5 heads. So what are those 5 heads of income? They are income from salaries, income from house property, profits and gains from business or profession, capital gains and income from other sources. After aggregating all these incomes, we will arrive at a figure called total income. Let us discuss each head of income one by one, and today our topic will be income from house property, which is comparatively small when comparatively smaller than other heads of income. Let us first quickly discuss few points regarding house property. House property means a building or land appertaining thereto. And if the assessee is owner of a house property, he will either self-occupy such property, that means he is living in such property, or he will let out such property for rent. So the income for house property can be generated only when the property is let out for rent. Such rental income will determine the annual value of the property, which is taxable under the head income from house property. The charging section is section 22. There should be a house property and the assessee should be owner of that house property, and the income which is generated from the house property will be in the form of rent. So if there is rent, if the property is let out for rent, the rental income will be generated and annual value of the property will be established. If the property is self-occupied by the owner, there will be no rent, there will be no income from the house property, and there might be a loss on such house property if the person has taken loan for construction, acquisition or repairs, renewals or reconstruction of such house property. When he claims deduction for interest on such loan borrowed for acquisition, construction, repair, renewal or reconstruction of the house property, if he claims deduction in respect of such interest, then there might be loss if the assessee is owner of a self-occupied house property. Let us discuss all these concepts in detail as we further head into our session. Computation of income from house property. To compute the income from house property, we have 3 steps. The first one is computation of gross annual value. The second step will be deduction of municipal taxes. We will arrive at net annual value after deducting municipal taxes from gross annual value. The third step will be providing for deductions under section 24. Under section 24, there are 2 deductions. Under 24A, we deduct 30% of net annual value. In under section 24B, the second deduction is the interest on borrowed capital. We can claim the interest amount payable on the borrowed capital as a deduction under section 24B. Then we will arrive at a figure which is considered as income from house property for our tax purpose. First step is how to compute gross annual value. For the computation of gross annual value, first let us revise few important terminologies. The first one is municipal value. Municipal value of any house property is determined by municipal authorities for the purpose of levying municipal taxes, and these municipal taxes will be deducted from gross annual value of the house property to arrive at net annual value. The next term is fair rent. The rent which a similar property in a similar locality, the same locality would fetch, is called fair rent. The third terminology is standard rent. It is fixed by Rent Control Act. Then comes the expected rent. To arrive at expected rent, first we have to consider the municipal value and fair rental value. We have to take higher amount of municipal value or fair rental value, and then we have to compare that figure to standard rent. Out of those both, we have to take the value which is low. So the lowest of standard rent or higher of municipal value or fair rental value is expected rent. First we have to compare municipal value and fair rental value. We have to take out the figure which is higher. With that higher figure, we compare standard rent value and we take the lowest of both, that is expected rent. Then comes actual rent received or actual rent receivable. Rent actually received during the previous year or receivable on the house property during the previous year is actual rent received or receivable. Gross annual value. Gross annual value is nothing but higher of expected rent and actual rent. The higher figure between expected rent or actual rent is taken as gross annual value. Let us go through one illustration which has been already provided in our institute material. Determine the gross annual value. The municipal value in the first house property is 80,000. Then the fair rental value of the same house property is 90,000. We have to take higher of 1 and 2, that is 90,000. The standard rent is not given here, so we take 90,000, that is higher of municipal value or fair rental value as expected rent. The actual rent is given as 72,000 in our question. When we compare expected rent and actual rent, the higher of both is expected rent. So we take 90,000 as gross annual value. In the second case, municipal value is 55,000, fair rental value is 60,000. We take higher of 1 and 2, that is 60,000. The standard rent given is 75,000. When we compare both the figures, the lowest figure, that is 60,000, is to be considered as expected rent. Comparing expected rent and actual rent given, that is 72,000, we take gross annual value as higher of ER or AR, expected rent or actual rent, that is 72,000. Coming to the third house property. Here both municipal value and fair rent are 65,000. So we take 65,000 amount and compare it to the standard rent which is given as rupees 58,000. Lower of 65,000 or standard rent, that is 58,000 will be our expected rent. When comparing expected rent to actual rent, that is 60,000, we take 60,000 as gross annual value of the house property. Higher of expected rent or actual rent is gross annual value. Next house property, the fourth one. The municipal value is 24,000 and fair rental value is 25,000. Highest of both is 25,000. Standard rent is not given, so we take 25,000 as the expected rent and actual rent is 30,000. Higher of both is 30,000, that is our gross annual value. The fifth house property. The municipal value is 80,000, fair rental value is 75,000. When we compare both the figures, the highest one is taken, that is 80,000. The standard rent is given as 78,000. Comparing the both, we take the lowest of both. The lowest of 80,000 or standard rent, that is 78,000 as expected rent. Actual rent is given as 72,000. Comparing the both, we take highest of expected rent or actual rent as our gross annual value, that is rupees 78,000. Let us go to our next topic, that is municipal taxes. The second step in computation of income from house property is deduction of municipal taxes. We arrive at net annual value after deducting municipal taxes from gross annual value. Municipal taxes can be deducted only if the assessee is the owner of house property and has actually paid taxes. Municipal tax can be deducted only if the assessee is owner of the house property and also he should pay the tax. He should pay the municipal tax. If tax is levied by authorities in previous year, but the assessee has not yet paid the municipal taxes, then no deduction will be allowed for the previous year. But if arrears of municipal taxes are paid in subsequent year, the assessee has not paid municipal taxes in the previous year and now he has paid the municipal taxes in subsequent years. In such a case, the deduction will be allowed for such a year in which actual payment has been made. Reduction of municipal taxes is allowed for previous year in which they are actually paid. Coming to the next point. House property located outside India. When the house property is located outside India, the municipal taxes will be levied by local authority of the country, and such taxes are deductible under our Income Tax Act. The next point. For self-occupied property or unoccupied house property, the gross annual value is nil. So, we cannot deduct municipal taxes. For the self-occupied or unoccupied properties, the gross annual value will be nil. In such a case, the municipal taxes cannot be deducted because GAV computation is solely based on rent. The municipal value, fair rental value, standard rent, ER, actual rent. We have to follow all these steps to compute GAV. When the property is let out, we can compute the gross annual value, but when the property is self-occupied by the owner, in such a case he will get no rent and hence the gross annual value will be nil in case of self-occupied properties by owners. When the GAV is nil, we cannot claim any deduction of municipal taxes. Coming to our next topic, deductions under section 24. The third step in computation of income from house property is providing for deductions under section 24. There are two deductions which can be claimed. The first one under section 24A, the standard deduction. Flat 30% on net annual value is allowed as standard deduction. Except there are few exceptions when the standard deduction cannot be claimed. That is simply when the net annual value is arrived when we deduct municipal taxes from gross annual value, and when the net annual value is nil, GAV is nil, we cannot claim any municipal taxes as deduction, and so our NAV is also nil. In such a case, this flat deduction cannot be allowed. What are the cases where the net annual value is nil? The net annual value is nil in case of self-occupied properties. When the house property is occupied by the owner himself, it is not let out for rent. The second case. Here, in case of the property held as a stock in trade, the first condition is the property is held as stock in trade, and whole or any part of the property is not let out during whole or any part of the previous year. The first condition is the property is held as stock in trade. The second condition is the whole part or a portion of the property is not let out during the whole year or any part of the previous year. The third condition, up to 2 years from the end of financial year in which certificate of completion of construction of property is obtained from competent authority. For properties which are held as stock in trade and which are not let out during the previous year, the assessee can claim, the assessee can take net annual value as nil, but it is allowed only up to 2 years from the end of financial year in which certificate of construction of property is obtained from competent authority. A competent authority has given you the certificate of completion of construction of property. From the end of such financial year up to 2 years, the assessee can claim NAV as nil. He can take the net annual value of property as nil if the property is held as stock in trade and it is not let out during the whole or any part of the previous year. I hope it is clear for you. Heading to our next section, that is section 24B. The second deduction allowed under section 24. The interest on borrowed capital. The interest on borrowed capital under section 24B can be claimed as deduction if the loan is availed for A, C, RRR. A being acquisition, C being construction, RRR being repair, renewal or reconstruction of the property. The interest payable on such loan in previous year is deducted. Make this clear, guys. It is the interest on the loan which can be claimed as deduction under section 24B, not the repayment portion. The interest part which is payable on such loan in the previous year, which is payable in the previous year, can be claimed as deduction under section 24B. Interest for pre-construction period. There is a small concept called there is a term called pre-construction period interest. The interest on loan for the period prior to the previous year in which the property is acquired or constructed is called pre-construction period interest. That is, starting from the date of borrowing, the date of availing the loan, till the 31st March before the financial year in which the construction is completed. Such period is called pre-construction period, and the interest which has been paid or which has been accrued during such year is called interest for pre-construction period. This interest can be deducted over a period of 5 years in equal installments. That is, in the next 5 years, commencing from the year of acquisition or completion of construction. Commencing from the year of acquisition or completion of construction of the property, the assessee can claim deduction of such interest for a period of 5 years in equal annual installments. That is, 1/5 of such amount is can be claimed as deduction every year. Let us once go through an example to get a clarity on this concept. Here, Mr. A has acquired a loan of rupees 10 lakh on 1st August 2020 at interest rate 9%. The construction of property is completed on 31st December 2022. Now, while filing the return of income in the assessment year 2023-24 for the previous year 2022-23, Mr. A can claim the interest payable on borrowed capital for the financial year 2022-23 as deduction, along with the pre-construction period interest which has been accumulated. That means the interest which is payable by A for the financial year 22-23 can be claimed as deduction. Along with that, in the assessment year 2023-24, since the construction has already completed in the previous year, the assessee can also start claiming the pre-construction period interest which has been accumulated from the date of borrowing to 31st March of 2022. From the date on which the loan has been borrowed till 31st March before the financial year in which construction is completed. The construction of the property is completed on 31st December 2022. So, the pre-construction period will be starting from 1st August 2020 till 31st March 2022. And such interest is calculated as pre-construction period interest. Let us go through how the interest has been accumulated in the previous years 2020, 2021. On the amount of loan borrowed amount, that is rupees 10 lakhs, 9% interest is calculated for 8 months period only. Since we have borrowed the loan on 1st August 2020, the loan has been availed for 8 months only in the year 2020-2021. The interest amount is rupees 60,000 for such year. Then, for the previous year 2021-2022, the interest accumulated will be rupees 10 lakh into 9% for whole year. That is rupees 90,000. So the total pre-construction period interest will be 1,50,000 only. We cannot calculate the pre-construction period. We cannot claim the interest which has been charged from 31st March 2022 to 31st December 2022 as pre-construction period interest. It will be claimed as deduction as interest payable in previous year by the assessee in the assessment year 2023-24. We calculate the pre-construction period interest till 31st March only. Hence, starting from the assessment year 2023-24 for the previous year 2022-23, Mr. A can claim a deduction of rupees 30,000 per annum, that is 1/5 of pre-construction period interest being rupees 1,50,000 in respect of pre-construction period interest for the previous year 2020 to 23, along with the interest payable for the financial year 2020 to 23. He can claim 30,000 pre-construction period interest, and also along with such interest he can also claim deduction for the interest which he has interest payable from 1st April 2022 to 31st March 2023. I hope it is clear for you. Coming back to section 24B, we have left out one point, that is interest payable on fresh loan taken to repay original loan is also admissible as deduction. Here the assessee has taken a fresh loan to repay the original loan. Interest on such fresh loan can also be claimed as deduction under section 24B. Now, we know that any house property can either be self-occupied by the owner himself or it can be let out for rent. And also currently there are two tax regimes running, one being default tax regime under section 115 BAC and another one optional tax scheme as per normal income tax provisions. Let us see how deduction under section 24B can be claimed for both sorts of properties under both the regimes. Deduction in respect of loan borrowed for a self-occupied property. An assessee has borrowed a loan for property and currently the assessee is living in such house property. He has to pay tax under section 115 BAC, that is the default tax regime. Section 115 BAC clearly states that no deduction can be claimed under section 24B in respect of self-occupied property. So any assessee who is living in a self-occupied property cannot claim deduction in respect of loan borrowed for such property if he is paying tax under 115 BAC. Remember these keywords: under section 115 BAC, 24B deduction cannot be claimed in respect of self-occupied property only. Under the optional tax scheme, loan borrowed on or after 1st April 1999. The loan here is borrowed on or after 1st April 1999. In such a case, for properties which are acquired or constructed within 5 years from end of financial year in which loan is borrowed. We are discussing about acquisition or construction within 5 years for a self-occupied property. The actual interest paid for one or two self-occupied properties subject to maximum of rupees 2 lakh can be claimed. So under optional tax regime, what our income tax provision says, the assessee here has borrowed a loan. He acquired or constructed the property, that too within 5 years from the end of financial year in which he has borrowed the loan. He has to acquire or construct the property. In such a case, he can claim the actual interest paid either for one or two of the self-occupied properties. The threshold limit is he can claim actual interest paid on acquisition or construction of two self-occupied properties. But the threshold limit on amount will be rupees 2 lakh only. He can claim only up to 2 lakhs for self-occupied property which has been acquired or constructed within 5 years, and he can claim deduction for two such self-occupied properties. Remember these 4 points. The first point is he should acquire or construct the property, that too within 5 years from the end of financial year in which loan has been borrowed. The third point is he can claim deduction in respect of two self-occupied properties. The fourth point is he can claim only maximum up to the maximum amount of rupees 2 lakh only. The next point, for RRR, that is repairs, renewals or reconstruction, The actual interest paid for one or two self-occupied properties, the maximum limit being rupees 30,000 only. Here, remember these points. The first point is for RRR, repair, renewal or reconstruction of self-occupied property under optional tax regime. The assessee can claim 24B deduction of actual interest paid for up to two self-occupied properties, and the maximum limit will be 30,000 only. Now let us discuss about let out property. For let out property, there is no ceiling limit in respect of interest on loan borrowed for a property let out or deemed to be let out. That means in case of self-occupied property, the GAV is nil, the NAV is nil, so the assessee is claiming deduction under section 24B now. In such a case, when 24B deduction is claimed, the assessee will get loss from house property of maximum rupees 2 lakh in case of acquisition or construction, and maximum of rupees 30,000 loss in case of repair, reconstruction or renewal in case of self-occupied property. But when it comes to let out property, the assessee is already getting rent on such property. We can compute GAV, we can claim for deduction of municipal taxes, we will arrive at NAV. On such amount, we are claiming 30% standard deduction. And now, the assessee can also claim deduction in respect of interest on loan borrowed for such property without any threshold limit. So, there is no ceiling limit in respect of interest on loan borrowed for a property let out or deemed to be let out. Even under section 115 BSE, the assessee can claim 24B deduction if the property is let out property, and there is no ceiling limit, no maximum amount of there is no threshold limit for claiming the interest amount as deduction. Interest is allowable on accrual basis. Remember this point. The municipal taxes can be claimed as deduction if they are paid, if and only if such taxes are paid by the assessee in the previous year. But when it comes to interest, the interest amount can be claimed as deduction on accrual basis. The interest payable amount will be deducted under section 24B. Interest on unpaid interest is not deductible. That means the assessee is not paying interest regularly, and the lender has charged interest on unpaid portion of interest amount. Such interest on interest cannot be claimed as deduction under section 24B. If a fresh loan is taken to repay the old loan, the interest on such fresh loan can be claimed as deduction. But the interest which has been charged on unpaid interest amount cannot be claimed as deduction under section 24B. I hope it is clear for you guys. Let us now discuss the next section, section 25. After computation of GAV, we will deduct municipal taxes and arrive at net annual value. We will provide for deductions under section 24A and 24B. We will arrive at a figure income from house property. Let us now discuss few miscellaneous points which are covered under section 25, that is inadmissible deductions. Inadmissible deductions, which means the deductions which cannot be claimed. Interest chargeable under this act payable outside India shall not be deducted if tax has not been paid or deducted from such interest. The interest amount here is payable to person who is residing outside India, and no TDS has been deducted from such interest amount. Then it is an inadmissible deduction. That means the assessee cannot claim such interest amount as deduction in our as per the provisions of our Income Tax Act. Next point. Interest chargeable under this act payable outside India shall not be deducted if, in respect of which there is no person in India who may be treated as an agent. There is no person in India who is acting as an agent for paying interest outside India. In such a case, such interest amount will be called inadmissible deduction as per our income tax provisions. Section 25A. Arrears of rent or unrealized rent received subsequently. There may be cases where the assessee cannot realize or receive the whole rent amount during few months in any of the previous years, and now such rent amount has been recovered or realized in the subsequent years. In such a case, such rental amount will be taxable in the year of receipt or realization. The rent which has been previously not recovered or realized from the tenant is now being received or realized and in the subsequent years. In such a case, such rental amount which the assessee has recovered from the tenant in subsequent years will be taxable in the year of receipt or realization. When it is received, it will be taxable. And also, deduction at 30% of rent received or realized is allowed. On such rent which has been recovered subsequently, in subsequent years, it will be taxable, and the assessee can also be claim 30% of rent received as deduction. Such rent is taxable even if assessee is not the owner of the property in the financial year of receipt or realization. Now the assessee is not the owner of the house property in respect of which the previous tenant has paid the balance rent amount in the subsequent years. In the current year, the assessee is not owner of the property, but still, since the rent amount belongs to the previous year in which the assessee has been the owner of such property, and now it has been realized, now the rent amount has been recovered from the tenant, the such amount rent will be taxable. He can claim the deduction 30% in the year of receipt. It doesn't matter if the assessee is currently the owner of the property or not. Once the arrears of rent has been received, it will be taxable in the year of receipt, and the assessee can also claim 30% deduction of such rental amount. There are few points to be noted. First, ROR, who is individual or HUF, if he can generate income from house property outside India. There is an house property outside India of resident and ordinarily resident individual or HUF. It will be taxable. But for non-resident or resident and not ordinarily resident, income from house property situated outside India is taxable only if it is received in India. If it is received in India, though the house property is located outside India, it will be taxable for NOR or RNOR, non-resident or RNOR. If the house property is situated outside India and the rental income is not received in India, it is not taxable for NR or RNOR. Now let us discuss the Rule 4. Rule 4 pertains to actual rent received or receivable. It states that the actual rent received or receivable should not include any amount of rent which is not capable of being realized. While computing gross annual value, we consider higher of expected rent or actual rent as gross annual value. How to determine actual rent? For that, Rule 4 prescribes few conditions. The actual rent received or receivable should not include any amount of rent which is not capable of being realized if the following conditions are satisfied. There are few situations where the assessee cannot recover the whole amount of rent from the tenant. It may be for 1 month or few months or few years. In such a case, while computing gross annual value, the assessee cannot include such amount which is due from the tenant. But there are few conditions where the assessee cannot take the whole cannot include such rent which is not capable of being realized from the tenant. Such conditions are: the tenancy is bona fide, the defaulting tenant has vacated or steps are taken to compel him to vacate the property. Here the tenant who is not paying the rent has either vacated the property or steps have been taken to make him vacate the property. The defaulting tenant is not in occupation of any other property of assessee. If not this house property, there may be some other house property in which the tenant is also has also taken any other property for rent. And such defaulting tenant, the one who is not paying rent on time, should not be in occupation of any other property of the same assessee. Assessee has taken all reasonable steps to institute legal proceedings for recovery of unpaid rent. The assessee has initiated steps to institute for legal proceedings for recovery of unpaid rent. He wants to claim the unpaid rent, or the assessee satisfies assessing officer that legal proceedings would be useless in the case. If these 4 conditions are satisfied, then the actual rent should not include the amount which is due from the tenant, from the defaulting tenant. If these 4 conditions are satisfied, while computing GAV, we will not take the rental income which is due from the tenant. I hope it is clear for you. We will discuss few illustrations to get a better clarity on these concepts. Before that, let us go through the last 2 sections of the chapter, that is section 26, co-owned property, and section 27, deemed ownership. Section 26, co-owned property. In case of let out property which has been co-owned by 2 assessees or more. Co-owned property means the same house property is being owned by 2 or more assessees. More than one person is owning the same house property. In such a case, if the property is let out to some other person, then the income from such property shall be computed as if the property is owned by one single person, and thereafter it is apportioned amongst co-owners as per their specific share. If a property which is co-owned by more than one person, we will first compute the income from such property as if the property is owned by a single person. Once we arrive at the income from house property figure, then we will apportion it based on the specific share of the co-owners, and such share will be the income from house property for the respective assessees, respective co-owners. In case the co-owned property is self-occupied property, here more than one person is owning the property and more than one person is in occupation of such property. He has occupied such property, he is living in such house property. The annual value will be nil, and each owner can claim deduction under section 24B of rupees 30,000 or rupees 2 lakh, as the case may be. It says the annual value will be nil. We know that for self-occupied property, NAV is nil. The assessee cannot claim 30% standard deduction under section 24A. But under section 24B, the assessee, each one of them can claim 30,000 or 2 lakh if he has taken a loan. If the assessee has taken a loan on the house property, either if it is for RRR, he can claim 30,000. If it is for A or C, acquisition or construction, he can claim maximum of 2 lakh, as the case may be. But if they own other property too, the deduction amount cannot exceed 30,000 or 2 lakh for optional tax regime. For co-owned property, if it is self-occupied property, under section 115 BAC, we cannot claim 24B deduction. It is clear. But if it is self-occupied property, it is co-owned by more than one person and they are paying tax under optional tax regime. Let us take a case where A and B are co-owners of a property. Here, A can individually claim deduction under 24B. He can claim maximum up to 30,000 in respect of RRR. And maximum 2 lakh deduction can be claimed by A in case of acquisition or construction. Coming to B, even B can claim the deduction of 30,000 in case of RRR and 2 lakh in case of A and C. But if they own other property too, in such a case, the maximum amount of deduction under section 24B should not exceed either 30,000 or 2 lakh individually. This is for optional tax regime, self-occupied property and co-owned property. Heading to our next section, that is section 27, deemed ownership. There are few cases where though the assessee is not legal owner of the property, the assessee is deemed to be the owner of the property. Though not legal owners of the property, they are deemed to be owners of the property. What are such cases? There are 5 such cases and let us discuss them one by one. The first case is transfer of property to a spouse or minor child, otherwise than for adequate consideration. Here the assessee is transferring the house property either to his spouse or minor child for inadequate consideration. In such a case, the person, the transferor, is considered to be the deemed owner of the property, though legally on paper he is not the owner of the house property. Exceptions. For this case, there are 2 exceptions. In case of transfer to spouse, in connection with an agreement to live apart, the couple has been staying apart, they are in an agreement to live apart, and now the person here, the assessee, is transferring the property to his spouse for inadequate consideration. In such a case, not the assessee but the spouse will be the owner of the property. As per the paper, the spouse is the legal owner of the property, and also for the tax purpose, the spouse will be the owner of the property in case of agreement to live apart, and the transfer has been taken place for inadequate consideration. In case of transfer to a minor married daughter, assessee has transferred the house property to minor married daughter. In such a case, on the paper, the minor married daughter is the legal owner, and also for the tax purposes, she will be the legal owner of the house property. But if the assessee is transferring the property to spouse or minor child for inadequate consideration, we will consider the assessee himself is the owner of the property, even though on paper he is not the legal owner of the property. In these cases, in case of the transfer to a spouse or minor child, otherwise than for an adequate consideration, the assessee is deemed to be the owner of the property. Second case, holder of an impartible estate, deemed to be the owner of all properties comprised in the estate. What is impartible estate? Generally, impartible estate means any property which is not subject to partition among the members. It cannot be divided, but held by one single member, usually the eldest one. So he will hold the property as the owner. Such owner of impartible estate will be deemed to be the owner of all the properties comprised in the estate. The next case, the third case, is member of cooperative society, company or other association of persons. Here the member will be deemed owner. Member of cooperative society or company or other association of persons will be deemed owner of property if to whom a building or part thereof is allotted or leased under a house building scheme of such entity. If such person has been allotted or leased part of building by the entity, though on paper the cooperative society or company or association of person is legal owner, the member will be considered as owner of such house property, deemed owner of such house property as per our income tax provisions. Heading to our fourth case, a person who is allowed to take or retain the possession of any building or part thereof in part performance of a contract. Here there is a seller and buyer. As part of agreement, it has been stated that the buyer can take or retain the possession of any building or part thereof in part performance of a contract. In such a case, the buyer will be deemed owner of the house property. When the buyer is considered as deemed owner of the house property, the cases are: number 1, possession of property has been handed over to the buyer. The property is now possessed by the buyer. Sale consideration has been paid by the buyer or promised to be paid to the seller by the buyer. Either the sale consideration has been paid or promised to be paid. In such a case, the buyer will be deemed owner of the property. Sale deed has not been executed yet in favor of the buyer, but certain other documents like power of attorney or agreement to sell or will, etc. have been executed. Though the sale deed has not been executed, the other documentation has been executed. In such a case, the buyer will be deemed owner of the property. In all the above cases, the buyer would be deemed to be the owner of the property, although it is not registered in his name. Heading to the last point under this section, the fifth point, the fifth case: a person who acquires any rights in or with respect to any building or part thereof, transfer by way of lease for not less than 12 years, shall be deemed to be the owner of that building or part thereof. There is an exception to this case which states that in case the person acquiring any rights by way of lease from month to month or for a period not exceeding 1 year, such person will not be deemed to be the owner. Here, there is a person who has acquired rights of a building or part thereof by way of lease, and that lease has been continuing for a period not less than 12 years. In such a case, that person shall be the deemed owner of the property. If the period has exceeded 12 years, he shall be the deemed owner of the property. But if the person has been constantly entering the lease agreement, like he has been acquiring rights by way of lease from month to month or in breaks, and he has been acquiring rights for a period of 12 years, for a period not exceeding 12 years, for not less than 12 years. In such a case, the person shall not be the deemed owner. If the lease is continuous, he will be considered as deemed owner of the property. If the lease has been executed in parts for the same property and the period is not less than 12 years, then he shall not be considered as the deemed owner. With this, we have revised all the concepts of the head income from house property, and let us discuss few illustrations based on cases. There are 6 cases which have been stated in our institute material, and let us discuss those cases and illustrations under such 6 cases in the next video. Thank you for watching this video, guys.